If you want to understand why a great many people are going to feel poorer in the next few years, even if they do everything they were told to do, you have to start with a very unpleasant truth. There are seasons in an economy when hard work is enough to move you forward. There are seasons when patience is enough. There are seasons when simply being reasonably prudent will save you from most mistakes. And then there are seasons when the machine itself turns against ordinary common sense. This is one of those seasons. I have spent most of my life watching people make the same category error in markets and in personal finance. They assume every bad environment will behave like the last bad environment. They assume every slowdown is just another recession. They assume every inflation scare can be cured by the same medicine. They assume the men in Washington, the central bankers, the economists on television, and the people who produce elegant charts all still have a comfortable range of options. What worries me now is not merely inflation. It is not merely slower growth. It is not merely weaker consumers, higher unemployment, tighter credit, or a geopolitical shock moving through the plumbing of the world. It is the combination. That combination has a name, and I want to describe it in plain English, because if you misunderstand the disease, you will almost certainly choose the wrong treatment. A recession is miserable, but it is at least familiar. Demand falls, people buy less, businesses cut back, jobs disappear, the economy softens or contracts in that world. Prices often cool because the public has less money and less willingness to spend it. That is painful, but the central bank has a playbook. It can cut rates, it can add liquidity, it can try to cushion the fall. Stagflation is different. Stagflation is what happens when the economy weakens and prices still rise. It is when the patient runs a fever and loses blood at the same time. It is slow growth or negative growth married to rising unemployment, but with high inflation sitting on top of it like a weight on the chest. That is what makes it so nasty. It is not one problem. It is a trap built from two problems that demand opposite cures. When growth is weak, you want easier money. When inflation is high, you want tighter money when both arrive together. The medicine for one condition tends to aggravate the other. That is when the neat language falls apart. That is when policymakers start sounding confident in public and cornered in private. That is when investors discover the difference between a difficult market and a structurally hostile one. I have always believed that if you want to make sense of a big financial moment, you should stop looking at headlines first and start looking at mechanisms. A headline is a mood. A mechanism is a chain. Mood changes by the hour. Chains move wealth. The chain here begins with supply. When a critical commodity is disrupted at a choke point, the consequences do not stay in one corner of the economy. They move outward. They move into shipping, energy, industrial inputs, transport, agriculture, household bills, margins, wages, hiring, and sentiment. A lot of people talk about oil as if it were just another line item. It is not. Oil is the bloodstream of a modern economy. When the flow is interrupted, the symptoms show up everywhere else. That is what makes this environment different from the easy stories people like to tell themselves. If prices were rising because consumers had become too euphoric and borrowed too much to buy televisions and vacations, that would be one kind of inflation problem. If prices were cooling because households had pulled back and companies were discounting to move inventory, that would be a more ordinary slowdown. But when a supply shock hits the energy system, and when it also touches shipping lanes, metals, fertilizers, chemicals, and transport routes, you do not get a neat little inflation report that stays where it started. You get pressure entering the cost structure of almost everything. You get a machine in which producers pay more before they ever sell a finished product. You get businesses that are squeezed even if demand is not strong. You get households paying more even as their own sense of financial security deteriorates. That is the first mechanism. The second mechanism is monetary memory. An economy does not simply respond to what happened this month. It also responds to what was done to it for years before this month. If you spend a long time papering over pain with easy money, balance sheet expansion, and aggressive liquidity support, you do not remove the problem. You alter the path by which the problem returns. I have heard people say for years that every major distortion can be solved with one more round of support, one more rescue, one more injection, one more program with a cleaner name than its substance deserves. I have never liked that way of thinking. When you create too much money for too long, you do not abolish arithmetic. You merely postpone the moment when arithmetic reasserts itself. That matters now because a supply shock does not arrive in a sterile system. It arrives in a system already shaped by years of extraordinary monetary behavior. You cannot honestly look at the monetary history of the last 15 years, and especially the enormous burst during the pandemic era, and pretend it leaves no residue. It leaves expectations, it leaves habits, it leaves asset prices elevated beyond what many people mistake for normal. and it leaves policymakers with less room than they advertise. That is why this moment is so dangerous. Supply pressure is rising from the outside. Monetary aftereffects are still inside the body. Growth is slowing. The labor market can weaken, and the price structure still wants to move higher. You do not need a dramatic slogan to understand the danger. You just need to look at the contradictions. If the central bank cuts rates aggressively in a truly inflationary supply environment, it risks feeding the very fire it is meant to contain. If it raises rates hard into a weakening economy, it risks breaking demand, credit, employment, and public finances even faster. If it does nothing, it tolerates a world in which the public gets poorer slowly and persistently while confidence erodes. That is the policy dilemma. It is not academic. It is not theoretical. It is what happens when every available door has a cost attached to it. I learned long ago that most people only feel the economy when it becomes personal. They do not care about the phrase input costs until groceries are noticeably heavier on the monthly budget. They do not care about shipping disruptions until ordinary goods become awkwardly expensive. They do not care about money supply charts until they realize their salary cannot outrun the cost of living. They do not care about policy dilemmas until a mortgage, a car loan, a school payment, a medical bill, and a market drawdown all start to crowd the same month. Then it becomes real. Then the machine steps out of the newspaper and into the kitchen. And once it enters the kitchen, psychology changes. People who were confident become defensive. Businesses that wanted to hire begin to hesitate. Consumers who thought they were wealthy discover they were only liquid as long as asset prices kept flattering them. Investors who claimed to be long-term suddenly become desperate for short-term certainty. That is one reason stagflation is so destructive. It is not only a macroeconomic phenomenon, it is an attack on decision quality. It makes individuals cautious in the wrong places and reckless in the wrong places. They cut productive spending and keep status spending. They postpone real repair and cling to symbolic comfort. They sell good assets to satisfy near-term fear. They confuse activity with control. I have seen this pattern in one form or another for decades. When people sense that the environment has become harder, they start reaching for explanations that preserve the illusion that the old formulas still work. They tell themselves the central bank will rescue everything. They tell themselves inflation is only temporary. They tell themselves growth will return before unemployment worsens. They tell themselves rates will fall before the next refinancing wall matters. They tell themselves that because the authorities fixed previous problems, they can fix this one in the same way. That is exactly the kind of thinking that gets people trapped. Every era has its own constraints. The 1970s had one kind, today has another. And one of the most important differences is debt. I want to stay with that for a moment because almost every casual conversation about interest rates ignores the weight of sovereign debt. In a simpler world, if inflation became too dangerous, the medicine would be brutal but conceptually straightforward. Raise rates high enough, create real pain, break inflation expectations. Allow the economy to cleanse itself. That is easy to say when public debt is manageable, when refinancing pressure is tolerable, and when the political system still has the stomach for open hardship. It is much harder to say when the national balance sheet is grotesquely larger, when interest expense is already enormous, and when shorter duration financing makes the system more sensitive to what happens next. A country carrying a huge debt load does not get to cosplay fiscal toughness indefinitely. It can talk like Volcker without being able to live like Volcker. That is one of the central realities of this moment. People speak casually about repeating old cures without asking whether the patient could survive the dosage. Back then, the debt load was vastly smaller relative to the size of the economy. Today, the system is more leveraged, more financialized, more dependent on rollover, more dependent on confidence, and more politically unwilling to accept deep pain without immediately searching for a workaround. That is why I say the comfortable options are gone. We do not live in a world where rates can simply be driven to whatever level pure anti-inflation doctrine demands, with no consequence to the government's own interest burden, the credit system, the housing market, the consumer, and the political structure sitting above all of it, and we do not live in a world where rates can simply be crushed lower and money can be sprayed around again without reigniting the inflationary psychology that everybody claims to hate until the asset prices rise. This is why I think a lot of investors are still underestimating the seriousness of the setup. They are trying to price the future with recession logic in one hand and inflation logic in the other, while ignoring the possibility that both forces will coexist for a meaningful period. That makes portfolios fragile. It makes business plans fragile. It makes household plans fragile. It makes institutions sound more confident than they are. When I was younger, I made the same mistake many people make. Now, I looked at economic trouble mostly through the lens of markets. I asked what stock prices would do, what bonds would do, what commodities would do. Over time, I learned that the more important question is what kind of behavior the environment will reward and what kind of behavior it will punish. In an ordinary bull market, loose habits can still look brilliant for a while. In a straightforward recession, caution often looks wise. In a stagflationary environment, sloppy balance sheets, thin margins, excessive leverage, short-dated obligations, and lifestyles built on continuous optimism all become much more vulnerable. That is why this is not just a market discussion, it is a structural discussion. If your life requires low inflation, falling rates, easy refinancing, stable employment, calm asset prices, and consumer confidence to stay comfortable, then your life is more cyclical than you think. A lot of people between 35 and 60 discover that too late they think they built wealth. What they built was a complicated consumption machine that only works when the macro backdrop is forgiving. A stagflationary backdrop is not forgiving. It punishes dependence. It punishes inflexibility. It punishes anyone whose monthly obligations climbed faster than their true resilience. If you want the Buffett version of what to do in an environment like this, I will tell you plainly. The first rule is not to become the patient. The second rule is not to build a life that forces you to make bad decisions when the machine turns hostile. The third rule is to stop thinking of this as a short-term media event and start treating it as a longer test of structure. What do I mean by that? I mean cash flow first, margin second, debt discipline third, durable assets fourth, optionality everywhere. When people hear me say that, they often assume I am talking about becoming timid. I am not. I am talking about becoming hard to kill. That is different. A man who cannot be forced into desperate action is not timid. He is dangerous in the best possible way. He can wait. He can negotiate. He can refuse. He can act when prices are attractive instead of acting when emotion is hottest. He can let other people, as urgency, become his advantage. That is what this kind of environment rewards. You do not need to predict every twist of monetary policy to understand that principle. You only need to recognize that an environment with slowing growth and stubborn inflation creates a premium on resilience. Resilience starts with your personal balance sheet. If your emergency savings are cosmetic, fix that. If your household budget assumes inflation is someone else's problem, fix that. If your debt is short-term variable or psychologically heavier than you admit, fix that. If your investing plan depends on the central bank quickly rescuing every wobble in growth assets, revise it. If your career is in a cyclical area and you have been living as though every bonus will arrive forever, step back and re-examine the assumptions. That is not fear. That is adulthood. I have always found it strange that society praises responsibility in language, but often discourages it in structure. It tells you to be prudent, then hands you a culture built on leverage, comparison, and financial theater. It tells you to provide, then quietly teaches you to mistake visible consumption for strength. It tells you to save, then surrounds you with incentives to borrow. It tells you to invest for the long term, then floods you with minute noise that trains you to think like a frightened speculator. A hostile macro environment exposes all of that. It shows you whether your identity is tied to appearances or to actual durability. And that is why I believe the next phase is not just an economic test, it is a character test. If you keep your head, maintain liquidity, reduce fragility, and refuse to worship the old bull market habits, you may come through this era stronger than people with more income, more prestige, and more impressive-looking portfolios. I would rather own fewer things and possess more freedom than own more things and answer to every turn of the machine. Now let me return to the policy question, because a lot of people want a neat ending. They want someone to say, here is the one lever that solves it. Life is rarely that kind. In my judgment, a true easing of this setup would require some improvement on the supply side. If the energy shock eases, if transport channels normalize, if the cost pressure that entered the system begins to soften, then policymakers might regain a little room. But even then, that would not erase the deeper monetary legacy or the debt arithmetic. It would merely make the next decision less impossible. That is why I do not like the glib confidence that so often surrounds official language. The authorities can influence timing. They can influence confidence for a while. They can redistribute pain. They can postpone, but they cannot repeal consequences, not forever. That is the lesson I wish more people understood. The market can ignore a contradiction for a surprisingly long time. A government can borrow through discomfort for a surprisingly long time. A consumer can keep pretending for a surprisingly long time. A central bank can rename things for a surprisingly long time. But eventually the contradictions start speaking through prices, growth, employment, and social mood. And when they do, the public discovers that what looked manageable in percentages becomes brutal in lived experience. A few more dollars at the pump becomes a broader rise in delivered costs. A modest rise in producer costs becomes pressure on hiring. A gentle weakening in demand becomes a real strain on margins. An official inflation number becomes irrelevant to the family, whose actual basket of necessities says otherwise. That is another point I want to make clearly. People do not live inside headline inflation. They live inside personal inflation. They live inside the cost of rent, insurance, fuel, food, utilities, education, repairs, medicine, transport, and taxes. When that basket rises faster than their income, they do not care how elegantly the number is presented in a report. They feel the truth in cash flow, and cash flow truth has a way of stripping away ideology in that world. What matters is not what should happen, according to a model. What matters is what breaks first. Sometimes it is consumer confidence. Sometimes it is housing activity. Sometimes it is business hiring. Sometimes it is credit quality. Sometimes it is the public's faith that tomorrow will feel easier than today. When that faith starts to erode, spending patterns change in subtle ways before they change in dramatic ones. That is why I think investors who focus only on the obvious market signals will miss the broader shift. The broad shift is from expansion logic to preservation logic. That does not mean there will be no opportunities. Quite the opposite. Difficult environments produce exceptional opportunities for people with patience, liquidity, and emotional discipline. But the first opportunity is not a stock ticker. The first opportunity is to become structurally stronger while weaker hands are still pretending. Everything is normal. I would use this period to ask hard questions. How much of my confidence is based on asset prices staying elevated? How much of my lifestyle depends on financing conditions remaining easy? How much slack do I really have if inflation stays sticky and growth softens further? How much of my portfolio is truly durable versus merely fashionable? How much of my temperament depends on the world cooperating with me? Those are serious questions. They are better than asking which headline will move the index next week. I never thought much of that sort of guessing game. If you want to build wealth over decades, your main job is not to look clever every quarter. It is to avoid becoming so fragile that a hostile stretch forces you into compounding mistakes. The reason I keep returning to that phrase is simple. A lot of people think bad environments destroy wealth all at once. Usually they do not. Usually they destroy wealth by provoking a sequence of bad responses. A family with too little liquidity sells investments into weakness. A business with too much debt refinances at the wrong time. An investor without a plan chases whatever looks like immediate relief. A worker with no buffer accepts every miserable term because he has no choice. A government already overloaded chooses the least politically painful option, not the healthiest one. That is how wealth is lost. Not only through the event, through the responses, and that is also how wealth is preserved, not by denying the event, by controlling the responses. If I were sitting across the table from you right now, and you asked me what this environment demands, I would tell you it demands sobriety, not panic, not numbness. Sobriety, it demands that you see the world as it is, not as it felt 2 years ago. It demands that you prefer strong balance sheets over exciting stories. It demands that you favor businesses with pricing power over businesses that depended on cheap money and a forgiving customer. It demands that you respect liquidity. It demands that you understand the difference between a temporary markdown and a permanent impairment. It demands that you stop building your life around the assumption that somebody else will always arrive with a rescue plan before reality becomes uncomfortable. That is not cynicism. That is independence. I have often said that the best financial position in the world is to be able to make good decisions slowly. Stagflationary risk threatens that because it presses on people from multiple sides at once. It makes them hurried. It makes them irritable. It makes them vulnerable to bad bargains. Do not become hurried. Do not become irritable. Do not let the machine turn you into a worse investor, a worse partner, a worse business owner, or a worse steward of your own future. There is one more thing I want to say because it matters especially in a period like this. Many people secretly believe that if the system becomes difficult enough, then discipline no longer matters. I think the opposite is true. When the wind is at your back, almost any sail can look competent. When the wind shifts and the sea gets rough, craftsmanship begins to matter again. That is where we are heading. Craftsmanship in personal finance, craftsmanship in investing, craftsmanship in business quality, craftsmanship in emotional control, craftsmanship in saying, no, I do not know exactly when every piece of this will be recognized publicly. I do not know exactly how the sequence will unfold quarter by quarter. I do know this: if supply pressure remains intense, if growth weakens further, if policymakers are trapped between inflation on one side and economic deterioration on the other, then the old habit of assuming a painless rescue is going to fail a lot of people. Do not be one of them. Build margin, reduce fragility, own quality, keep liquidity, respect debt, refuse theater, and most of all, remember that in a period like this, the real goal is not to win an argument with a television. It is to come out the other side with your judgment, your optionality, and your future still intact. That is the test. And if you pass that test, a great many opportunities that look invisible to frighten people today will become obvious to you later. That is how long-term wealth is really built. Not by demanding an easy environment, by being the kind of person who can still act intelligently in a hard one.